Investing for beginners. Hello everyone. Hope you are doing well. Before proceeding with the video, please don't forget to subscribe to our YouTube channel for more exciting content. In this video, we will be going to explain what is the stock exchange, types of the stock exchange, pros and cons of the stock exchange, and what is stock sectors. What is stock exchange? A stock exchange is a marketplace where financial securities issued by companies are bought and sold. They are part of the broader capital market ecosystem. Securities issued by companies, such as shares and bonds, are traded on the stock exchanges after they have been issued in the primary market. Here are some types of stocks. 1. Growth stocks. Growth investing is an investment style and strategy that is focused on increasing an investor's capital. Growth investors typically invest in growth stocks, that is, young or small companies whose earnings are expected to increase at an above-average rate compared to their industry sector or the overall market. These stocks generally do not pay dividends. Classic examples of growth stocks include Facebook, Amazon, and Netflix Incorporation. 2. Income stock. Income stocks are stocks that offer regular and steady income, usually in the form of dividends, over a period of time with low exposure to risk. Income stocks usually offer a high yield that may generate the majority of the security's overall returns. Income stocks are mostly generated in sectors like telecommunication, utilities, consumer staple, healthcare, petroleum, and energy. 3. Value stock. A value stock is a security trading at a lower price than what the company's performance may otherwise indicate. Investors in value stocks attempt to capitalize on inefficiencies in the market, since the price of the underlying equity may not match the company's performance. In simplest terms, a value stock is one that is cheap in relation to such basic measures of corporate performance as earnings, sales, book value, and cash flow. Examples of what are commonly viewed as value stocks are Citicorp, ExxonMobil, and JP Chase. 4. Individual stock. Units of stock are called shares. Stocks are bought and sold predominantly on stock exchanges, though there can be private sales as well, and are the foundation of many individual investors' portfolios. When one invests in an individual stock, he or she is purchasing ownership. If an individual invested in 100 shares of a public company, that individual would have a percentage of ownership in that company. Examples of individual stocks are Caterpillar Incorporation, Citigroup Incorporation, and Clorox Company. 5. Mutual funds. Mutual funds are largely a safe investment, seen as being a good way for investors to diversify with minimal risk. But there are circumstances in which a mutual fund is not a good choice for a market participant, especially when it comes to fees. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. The combined holdings of the mutual fund are known as its portfolio. Investors buy shares in mutual funds. Examples of money market mutual funds are Schwab Value Advantage Money Fund, Ultra Shares, JP Prime Money Market Fund, and Vanguard Treasury Money Market Fund. 6. Index funds. An index fund is a mutual fund or exchange-traded fund designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. Index funds based on major indexes are popular for many reasons. These funds offer a good return over time, they're diversified, and a relatively low-risk way to invest in stocks. Attractive returns. Like all stocks, major indexes will fluctuate. The S&P 500 index, the Russell 2000 index, and the Wilshire 5000 Total Market Index are just a few examples of market indexes that index funds may seek to track. 7. Exchange-traded funds. An exchange-traded fund, ETF, is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs will track a particular index, sector, commodity, or another asset, but unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. ETFs are great for stock market beginners and experts alike. They're relatively inexpensive, available through robo-advisors, as well as traditional brokerages, and tend to be less risky than investing individual stocks. 8. REITs. REITs, or real estate investment trusts, are companies that own or finance income-producing real estate across a range of property sectors. These real estate companies have to meet a number of requirements to qualify as REITs. Most REITs trade on major stock exchanges, and they offer a number of benefits to investors. Investing in REITs is a great way to diversify your portfolio outside of traditional stocks and bonds, and can be attractive for their strong dividends and long-term capital appreciation. 9. Capital gains. Capital gain is an economic concept defined as the profit earned on the sale of an asset that has increased in value over the holding period. An asset may include tangible property, a car, a business, or intangible property such as shares. For example, say you purchase 100 shares of Apple stock, AAPL, for $120 per share. Your basis in the stock is $12,000. You later sell all 100 shares for $145 per share, or $14,500. Your capital gain would be $2,500. 10. Capital loss. A capital loss is the loss incurred when a capital asset, such as an investment or real estate, decreases in value. This loss is not realized until the asset is sold for a price that is lower than the original purchase price. For example, if an investor bought a house for $250,000 and sold the house 5 years later for $200,000, the investor realizes a capital loss of $50,000. For the purposes of personal income tax, capital gains can be offset by capital losses. Here are some pros and cons of stock exchange. Advantages of stock exchanges. Advantages of using your personal money to invest in the stock market include the potential return on investment and ownership stake in a company. Enhance market liquidity. By nature, shares that are listed are a very liquid product and can be bought and sold quickly over an exchange platform. No hassle of involving a broker or transferee, and at a relatively low cost as compared to other financial products. Well-regulated market. Online trading spreading geographically. Public debt platform long-term benefits. Disadvantages of stock exchange. Disadvantages include higher risk and the time involved in investment. It's volatile investments, high brokerage and low margin. It can be complicated and expensive, and there is the possibility of losing control, as anyone can buy shares. The profits are paid to shareholders and the business records are made public. What is stock sectors? A stock market sector is a group of stocks that have a lot in common with each other, usually because they are in similar industries. We categorize stocks into sectors to make it easy to compare companies that have similar business models. When investing, you can choose from stocks within the sectors that interest you. There are 11 stock market sectors, as classified by GICS, which stands for Global Industry Classification Standard. These sectors include healthcare, materials, consumer staples, consumer discretionary, utilities, energy, industrials, consumer services, financials, and technology. This is all about the investments that beginners should try. Thanks for watching. If you like our video, then hit the like button and don't forget to share and subscribe to our channel for more valuable videos.